With the Fed starting to talk about an increase in interest rates in the not too distant future, investors are confused. We'll review the hard evidence to sort things out. It's always a good idea in a tentative market to stop and review the big picture. We'll review the concerns from last week and answer the question, are they still there? What can we learn from small caps, materials, momentum, trends, opportunity costs? How does gold look? Checking in on that long-term breakout for stocks and addressing Friday's week close. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We currently have a market that lacks conviction from either a bullish or a bearish perspective. Under those circumstances, it's always good to take a step back and ask yourself, am I in the right place? Weekly trends, these are the periods where it's relatively easy to make money. This period here is indecisive and a little bit more difficult. However, we have an indecisive period here, a bullish breakout. On a weekly basis, we retested this. What once was resistance may now act as support. We still have a full-bore bullish look, price above blue and red, blue above red, and the slopes are up. So right now, this still favors a weekly bullish trend for the stock market. Would I rather be long or would I rather be short? Why do we look at it this way? We like to think in terms of opportunity costs. When this chart rolls over and has a bearish trend, it tells us a lot about every stock in the S&P 500. This chart here looks similar to this chart here, and it's sending similar messages. We're above this area here, still have a bullish look. Would I rather be in stocks or would I rather be in bonds? This is more confusing. This is consolidation. This is not a strong trend in either direction. This is a clear trend in favor of stocks. Since roughly December 1st of last year, the market's been very, very indecisive. This is not the type of trend that our model likes to see. This is difficult. This is indecision, indecision, indecision. However, it still sides with I'd rather be in stocks. As long as it stays this way and doesn't morph into a full-bore bearish look, we'll continue to err on the side of holding equities over bonds. Last week we said we were concerned that we had a weekly close below 10,301 and change. This week, the NYSE Composite recaptured this level, closing on Friday, March 21st at 10,392, which is above the 10,301 here. The longer we can stay above this level here, the better it is for the stock market bulls from a probabilistic perspective. Last week, using this monthly chart of gold, we said there were reasons to be interested in gold, but there were also reasons to be patient with gold. This is a monthly chart. We're trying to get the bullish moving average crossover, but we noted that it wasn't the end of the month and some patience was in order in terms of considering adding to the positions that we have and relatively small positions. This is the same chart a week later as of the close on Friday, March 21st, and the patience thus far has paid off. You can see now we have white space between the blue and the red, telling us that we do not have a bullish moving average crossover on this monthly chart. To add to our gold positions or to buy GLD, we'd prefer to see this chart look more like this than this. The concerning items on this chart dated March 14th, looking at the S&P 500's weekly trend, were that price was below both blue and red. Those are no answers to our binary questions. And the slopes of blue and red had turned down. So that starts to look like something like this here or this here, where the probability of bad things happening increased. We said in last week's video on Friday, March 14th, that if this morphed into something like this, where we got a bearish moving average crossover, that the odds of bad things happening would increase further. You can see here as of the close on Friday, March 14th, blue was still above red, and we did not have a full bore bearish look. We had a mixed look. How does it look as of Thursday or Friday of the following week? The short answer is the look is improved as of the close on Friday, March 21st. This is the same chart. Understanding this is difficult to see. Now we have price above both moving averages, blue above red, and the slopes are up. We look more like this, which is a full bore bullish look. It also appears here as resistance. Tested it and we passed, and you can see blue is slightly above red. All of the things that we discussed in last week's video were really about risk management, where we get the 50-day moving average rolling over on the daily chart of the S&P 500 as of the close on Friday, March 14th. This tells us that the odds of bad things happening have increased. We were also concerned that we lost this breakout here. This is a bullish breakout above this level, and we gave it back. This is a vulnerable look, but not a bearish look. We're still above the 50-day moving average, and for the most part, the longer-term slope is hanging in there. But this is concerning, and from a risk management perspective, having some more cash on hand until this gets cleared up makes sense. Similar to many of the charts that we've reviewed previously, this chart too improved this week. You can see the slope of the 50-day moving average on the same chart has ticked back up, and price during the last 5 trading sessions has recaptured this bullish breakout, and we're above the orange box. It's not all fun and games though. On Friday we made a new intraday high. This level here is higher than this level here. And then we had a sharp intraday reversal. Typically that's not a good sign. It's not something we use to make decisions, but from a technical analysis perspective and from a common sense perspective, it tells us that there was selling into this new high, and it just says that we have to keep an open mind next week about how things may play out. Our concern on March 14th was that we had a weekly close that dropped out of overbought territory, thus increasing the probability of bad things happening in the stock market. How does it look now? The answer is it looks better now as of the close on Friday, March 21st. Even taking into consideration the week close on Friday, the S&P 500 was still up 25 points this week, meaning the bulls took the week. They also recaptured the overbought territory. All things being equal, that's good. That doesn't necessarily mean we're out of the woods. You can see something like this in the past where you come up and get somewhat of a whipsaw effect and drop. But all things being equal, recapturing this more often than not is a good thing. This is the daily chart of the Dow dated March 14th that we looked at last week, and we said there were numerous reasons to be concerned. However, we did say that there was the potential for this support to hold and the potential for a bounce. We did indeed get a bounce here at the probable support. However, this chart is still a mixed bag. We haven't made a higher high here. This 50-day still looks tepid. And this is a yellow flag until it's erased. This is weak momentum. And typically, if you can't get back to overbought, the probability of further weakness increases. Doesn't mean this is dead in the water yet. You just want it to move into this direction next week rather in this direction. This is a chart we've described several times in the past, so we won't spend a lot of time on it. This is small caps here. This is the stock market or the S&P 500 here. You can see in 2011, small caps consolidated and went sideways for 5 months, helping foreshadow this waterfall decline in the general stock market. 2012, small caps, no progress for 3 months, helping foreshadow this decline. The present day, we continue to make a series of higher lows and higher highs. This is a bullish look and looks better than this period here or here, where weakness in the stock market followed. We're using very similar concepts here. Now we're looking at basic materials. This is a lot like XLB. This is the S&P 500. In 2011, you have a bearish divergence with materials foreshadowing this decline in the stock market. You have a clear bearish look to materials well before this decline. In the present day, we've got a bullish look. We're making higher highs and higher lows for the most part, and we've got a full bore bullish look from a moving average perspective. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.